Have you ever wondered, when is the right time to buy a stock? Have you analyzed market trends? Should you buy when prices are going up or declining? Is the stock price too high? Maybe you have heard stock analysts and investment advisors using the fancy term, market timing. Sounds overwhelming, right? Luckily, the reality is much simpler. In this video, we will tell you why and what to do about it. Here you will find answers to all those questions and clear guidelines. When is the right time and what is the right price to buy a stock?
Hello and welcome back to Financial Freedom Hub. Our today's video will answer two crucial questions: when is the right time to buy a stock, and when is the right time to stay away from the stock? To answer those questions, we will rely on wisdom from the world's greatest investors. We will also be talking about sneaky reasons why you should be extra cautious when seeking investment advice. But before we begin, here is a quick reminder for you. You might want to check out our playlists, How to Interpret Any Company's Income Statement, Balance Sheet, and Cash Flow Statement. Our videos in those playlists can teach you to understand any business, and this knowledge might just change your life forever. Now, let's get back to our today's topic. First, let's make it very clear that it's not about buying low and selling high. Buying low in a hope to sell high is fundamentally different activity. It's called trading. You might want to check out our other video, where we explain the difference between investing, trading, and gambling. You will find the link in the description. Here we are talking about investing, a strategy of putting your money into something, with expectation of earning a profit over a long period of time. This is why we are looking to invest in companies whose earnings are so stable that the shares of those companies are like bonds. We can also say that we are investing in underlying companies' earnings, and the share price is what we pay for those earnings. And what we are interested in is return on our initial investment, ROI. Consider this: when Warren Buffett first bought Coca-Cola shares in the late 1980s, his average cost price was $6.50 a share, and earnings were 46 cents per share. It meant him a 7% rate of return. Fast forward to 2007. The earnings now are 2.57, and cost base is still $6.50. The rate of return had grown from 7% to 39%. But if he had paid $20 for Coca-Cola shares, the initial rate of return would have been 2.3%, and by the 2007, the return would have grown only to 12.8%. Do you see the difference? So, what would be the answer to our first question: when is the right time to buy stocks? The simplest answer would be, during the bear markets. Even if the shares of those companies with stable earnings don't seem to sell at bargain prices, in the long term they are still better investments than shares of those that ride the market booms and busts. Now, speaking about the bargain prices, there is something that you need to know. Wonderful companies that have competitive advantages almost never sell at low enough prices from the point of view of value investors or those investment advisors who follow value investing principles. So next time, when you talk to your investment advisor, you need to be smarter and acknowledge that their assessment might be different because of their investment philosophy and not because of the quality of the investment. There are also times when a good company has a temporary issue or an event that sends its share price downward and creates a good buying opportunity. For example, in 1993, PepsiCo faced a crisis when a syringe was found in a can of Diet Pepsi. The company defended its reputation by providing a transparent report and sharing video footage of its canning process, which reassured customers and led to a recovery of its stock price within a month. Another example would be when in 2010, BP faced a major crisis with the Deepwater Horizon disaster, which had severe environmental impacts. BP's recovery strategy was a commitment to environmental responsibility, including a $20 billion compensation scheme, which helped the company bounce back from a $6 billion loss to a $26 million income by 2011. Our next question: when would you want to stay away from the stocks, even from those of the wonderful companies? These times come when the bull markets are at their highs, and the price-to-earnings ratios are at their historic highs. Remember the ROI. Too high share price lowers return and increases risk. How much is too much? Let's turn to the wisdom of the greatest investors. Warren Buffett has observed that historically, the market has evaluated shares of good companies relative to the long-term corporate bond rate of return. For more on this, please follow the link to the video, Equity Bonds, in the description. We believe that the stock price is good if it provides a return on investment equal to or greater than the rate of return of long-term corporate bond. Again, please bear in mind that this is not an investment advice, and please be aware that corporate bonds in different sectors have different returns. We hope you find this video useful, and next time, when you buy some stocks from the stock market, you will be better prepared to make the best decisions. You might also want to give us a like and share this video with your friends, and subscribe to our channel. Thank you for watching.